Hello, and thank you for joining us on the Optimal Wealth Podcast, where we discuss creating passive income through real estate. Our mission is to help educate investors on how to grow wealth and invest passively. My name is Jared Alexander, and I am a passive investor, currently in 6 syndications as a limited partner. I am also the founder of Optimal Equity Group, which is a real estate investment firm that was created primarily to help educate the passive investor. We do that in a couple of different ways. One is we provide education to help give you the confidence to get into the passive investing space. And two, each episode we will interview amazing guests that explore the strategies, insights, and secrets used by successful investors. Whether you're a seasoned investor or just starting out on your real estate journey, this podcast is designed to help give you the confidence and knowledge you need to make informed and profitable decisions. All right, welcome to another episode of the Optimal Wealth Podcast. And today I'm super excited to have our guest, Brian Alfaro. Brian, welcome to the show.
Thanks for having me. I'm excited to be here.
Thank you. Hopefully I didn't screw up your last name there.
No, you're good.
I just asked Brian how to pronounce it, and I totally just pronounced it a totally different way. So
I've heard it all.
Starting it off right here, Brian. But anyways, again, super excited to have you here, man. And we're going to dive into, Brian's background here and just a quick overview. He's the Director of Investor Relations and Marketing at Headway Capital. Prior to joining Headway Capital, Brian managed an investment company specializing in the residential asset class, passionate about helping others succeed. So Brian's extensive background in operations, marketing, and brand development in the high-volume hospitality concepts plays a role in ensuring investing partners receive a first-class experience. So he's a graduate of the University of Houston Bauer College of Business. So Brian, with that, if you could just walk us through your background, how you got started in real estate and where you're at today with Headway Capital.
Yeah, happy to. Again, appreciate the opportunity to speak to your audience. Like a lot of people that are probably listening to this podcast, I didn't have a lick of real estate experience 7+ years ago. I didn't grow up in real estate. I don't come from money. My dad was a very small business owner. My mom, still to this day, is a stay-at-home mom. I have a special needs sister, so we were very blue collar, to say the least. And I was the first person in my family to go to college. So I always had that hunger and that work ethic to try to reshape my family tree, so to speak, which has always been my big why. So I went to college, graduated from the University of Houston, and had a pretty successful career in the restaurant hospitality space for a long time. I worked for a large restaurant franchise, really helping them grow locations here in my market in Houston, Texas for a long time. And my wife and I got married back in 2016, and at the time, I'm still am to this day. I was a big reader. I like to read books, and we were buying our first house. I didn't know anything about real estate, so I started picking up books about how to buy your first house. How to make sure you get a good deal on your first house. All that. Do you really want to buy a fixer-upper? Like all these topics, right? And I stumbled on real estate investing. So these books that I was reading and stuff that I was listening to and watching started to talk about real estate investing, and let's just say I caught the bug. I found some great resources online. I started listening to podcasts, joining community events here locally here in Houston. And one thing led to another, and I decided I wanted to start investing in real estate. I had a little bit of extra money at the time, and I was doing pretty well in my career. So I thought real estate investing was two things: either buying a house and flipping it, or buying a house and keeping it. Mm-hmm. I knew absolutely nothing about anything else. So that's what I did. I started small, and because of my sort of lack of experience and mindset, I started just flipping houses and buying single family rentals. So did that for a couple of years, from 2017 into 2019, early 2020, and very quickly realized that it's a whole lot of work and there's not enough zeros at the end of the checks. It is how I like to describe it to people. So I had a conversation with my wife right before COVID. So timing was interesting. And I told her, I was like, hey, this residential real estate thing is going okay. We're making a few $100s per house as a rental once you pay your mortgage and all your stuff. But I think I want to do something bigger. I think I want to take on more of a challenge, and I'll do something that aligns better with my personality. So that's when I got into, started learning about commercial real estate and just reverse engineered it, just like I did the residential space. Started listening to podcasts like this, started reading books, just started watching YouTube videos, going to local networking events for commercial real estate, and eventually joined a real estate mentorship program as well to really help me learn how to both successfully actively invest in real estate, because that was my primary goal of being in my early 30s, is I wanted to be an active investor, and also, of course, learn how to passively invest in real estate in the proper way. So I did that, and I guess you could say you're off to the races. So that was 2020, and here we are 4 years later. And I can't even remember. I've invested passively in 8 or 9 deals, and then actively invested in a very similar number. And I guess you could say the rest is history. Now I sit in the director of investor relations seat here at a private firm based in Houston, where not only am I a passive investor, but I talk to our passive investor clients who are interested in partnering with an experienced operator that's buying real estate in Texas. So yep, that's been my journey.
Awesome, Brian. Well, yeah, quite a journey. Thanks for walking us through that. A couple questions, came up when you were going through your story. First, so was your first house, was that did you buy and hold or flip that, or just was that a primary that you lived in for a while? What did that look like?
No. The first house, I like to tell, there's kind of 2 first houses, I guess. The very first house I put under contract, I actually backed out of because I was scared, to be quite honest. It's very common in this space, even as a passive investor, you'll hear the phrase analysis paralysis, right? Where you want to overanalyze everything. And that's exactly what I did. So I went out, I found an investment house through a wholesaler. Usually they make you put like $5,000 of non-refundable earnest money down to lock up the house and take it off the market. And I did that. I put my $5,000 down, and I had my contractor come. We walked the property. We put an estimate in, and my hard money lender was ready to rock and roll. And I got cold feet, and I backed out and lost my $5,000. Well, I ended up watching that house because I saw that they sold it to somebody else, another investor. And about 3 months later, I see it hit the market for a number that my reverse engineering the math on what the renovations cost. That investor made about $45,000 in profit on a flip. The second I saw that, I told myself I would never let that happen again. I wouldn't get analysis paralysis, and I wouldn't get cold feet on an investment opportunity if it checks most of the boxes. So that was I like to call it my first investment, so to speak, the one that could have been. But my first one was a rental that I actually closed on. It was a little, I turned it into a 4-bedroom, but it was a 3-bedroom, 2-bath. It's like 1,800 square feet house. I paid $56,000 for it here in Houston.
Back in 2020?
That was at the very beginning of 2018.
Oh, wow. Okay.
Yeah.
Yeah. No, that's interesting too. I'm glad you mentioned that analysis paralysis. So I want to dive into that, and I was actually going to ask you this question, if individuals are looking to get into this space and they have that fear, what would you tell the new passive investor? What would be your suggestion as far as that?
Yeah. That's
you're captured by fear, right? It's like,
absolutely. Well, there's a saying that there's fear in the unknown, right? So if passive investing, if real estate investing, if investing in alternatives is an unknown to you, it's something you're very unfamiliar with. The reason you fear it is because you're not educated on it. It's the unknown, right? And education, as cliche and cheesy as it is, education is power, right? Because when you're educated, you make educated decisions. Now, I always like to preface to both active and passive investors, but mostly our passive investors, that look, there's risk involved, right? If you're trying to invest and you have a very, 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 very low risk tolerance, or you don't like risk at all, you probably shouldn't invest in anything. You shouldn't invest in stocks. You shouldn't invest in real estate. You shouldn't invest in anything, right? Because the reality is, I was at a real estate conference this past week, and somebody said there's risk in waking up every day and going to work. There's risk in going to the grocery store. There's risk in getting in your car every day and driving to lunch. And he's right? There is. You could get hit by a car and your whole life goes upside down. So there's risk in everything in life, including real estate. So I think the first thing is getting educated to a point where you understand that risk. That way, when you understand the risk, you can adjust what you're looking for to your personal risk tolerance, right? Because once you understand the risks that are involved with different types of real estate, whether it's commercial real estate, residential real estate, if you're looking at passively investing, there's different risks in multifamily versus self-storage versus mobile home parks versus triple net retail versus car wash. I mean, there's just different risk. And once you know what type of risk tolerance you have, you can align yourself with an asset class that aligns with your risk tolerance. And then you can get really, 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 really educated about that particular asset class. And I think that's really important for a new investor is don't try to be the jack of all trades, because if you're trying to passively invest in real estate, well, that's a very, very broad umbrella, right? I just listed like 7 asset classes that you can passively invest in. And I know operators in all those asset classes, and that's all they do. Well, why is that all they do? Well, that's because being a master, there's a saying you can be a master of one or a master of none, right? It's kind of hard to be an operator and say, yeah, we do car washes and we do self-storage and we do mobile home parks and we do RV parks and we do industrial and we do multifamily, we do office, we do triple net retail. Like there's just too much.
Yeah.
Most successful operators do 1, maybe 2 types of asset classes, unless they're massive and they have, 100 plus employees. That's sort of a different thing. But if you're a passive investor and you're first getting started, the first thing you should do once you understand your risk tolerance, you pick your asset class, is become a master of that asset class, and don't get shiny object syndrome just because you talk to a buddy and he got a 25% IRR on a mobile home park investment, and the stuff you're looking at is 22%, and now you're stepping over dollars, pinching pennies. Become a master of that asset class, and that education is going to help you get over the fear and the analysis paralysis part once you start looking at enough deals. And to be honest, I mean, some people have a high risk tolerance and it might take them a couple of weeks to get over it. And then some people have a low risk tolerance or a medium risk tolerance, and it might take them 3 months, 6 months, a year of looking at deals before they finally invest. And there's no right or wrong, but you have to be consistent and you have to get started.
Yeah. No, very, very well said. And, I like how you talked about what is an investor's goals, right? Like, so what are your goals as a passive investor or an investor, active, passive, whatever that is, and then simply determine what is your risk tolerance. Like Brian was talking about, I sit down whenever I have a conversation with a new investor. That's the first thing we do is look at I call it a discovery call, right? What are your goals? What are you looking to achieve here? What returns, risk tolerance, things like that. Because like in multifamily and these syndications we do, it's illiquid investment. So your money's tied up for 3 to 5 years, right? Are you going to need access to that money? Well, if so, this isn't the right investment for you, and we kind of just walk through some different scenarios and to see if it's a good fit, because in some cases it may not be. And like you said, just sticking to the stock market, bonds, mutual funds, what's familiar, right? Which one could argue there's a lot of risk involved there too, but it's familiar, right? Most people that hear about investing think, of that stock market, mutual funds, bonds, things like that. So, I like how you touched on that. And then one thing that kind of came to mind is when we were talking about fear, and in your case, Brian, is you had the fear of missing out on the next opportunity too, right? Because I mean, you saw that investor make $45,000 on that flip. And honestly, that I related to that because that's kind of how I got started too. I'm starting to see all these deals turn, especially in 21, 22, where I know there's a house across the street. I mean, a guy bought it for probably $650, and 4 to 5 months later, it's on the market for $200,000 more, right? And he probably put $100,000 in. I mean, he's probably walking away with 6 figures, right around there. And 5 months, and it was just okay, right? And you just start seeing these opportunities come across. So, yeah, thanks for walking us through that. And so we once you get into this, okay, I'm going to make a decision, niche down. There's that saying too: don't go a mile wide, go a mile deep, right? And it's kind of along the same thing Brian was saying is, find something that works, stick to it, get good at it, and then you can look at branching out to other, other opportunities and things like that. But find something to focus on first, because I know for me, I was like single family. Okay, I bought my first house. I got my foot over that threshold, that scary threshold, right? I was like, all right, now I'm an investor. Now I want to go buy 60 more houses. And just look at me, how am I going to scale this, right? I mean, it's for one, that was a lot of work finding that deal, especially in this market. To find a house that's cash flowing $200 a month is, few and far between. You got to really have some good deal flow or siphon through quite a bit. And two, again, the scalability. So, again, what are my goals? What am I looking for? Well, then I went to short-term rentals, and then I went to, okay, now I'm multifamily. I stumbled upon multifamily. Now I want to go out and be a syndicator. Do I want to be a syndicator? Do I, and you go through all these different scenarios. And so once you land on something, Brian, so in your case, I want to touch on this real quick because, we talk about this investing, but it takes money to make money, right? Especially in the passive side. So what did that look like for you? And you don't have to go into too much detail if you don't want, but like we know the single family route. Most people are familiar with that. I mean, you're either putting 20% down, you can do seller financing, you can do some creative financing, things like that. But in the passive space, I mean, if you're going to invest in a deal, you typically need $50,000. So how did you go about getting that money, and what did that look like moving forward in order for you to compound into nine deals?
Yeah, that's a great question. And that's a point that I think that's important to highlight, because these private placements, which is what they're called in our space, they are regulated. The SEC is involved. We don't have to get technical, but there's 506B, 506C, there's Reg A funds, Reg CF funds, there's fund of funds. There's so many different types of private placements, and they are regulated and have rules you have to follow. And one of the rules, so to speak, is that we don't ever want to take somebody's last dollar, right? So if one of my investments is $50,000 and you have $51,000 in your bank account, well, I don't want your $50,000 because one, that's too risky. It's all your liquidity. And two, those investors are often the ones that are the most nervous and scared and sort of hard to work with, to be quite honest, throughout the life cycle, because these investments, they're 3 to 5 years, right? This is not a 6 months, a 12 months, and there's zero liquidity. It's really hard to get out of them. I'm not going to use the word impossible, but really challenging to get out of them. So if you take somebody's last $50,000, I mean, they're going to be calling you like twice a week, like, hey, how's it going? Hey, how's it going? Hey, how's it going? And these deals that we're doing have 100 investors in them. You know what I mean? Like, we just can't, our system's not designed to sort of work on that scale. So we're looking for investors that have $50,000 or more. And if they lost it, and we've never lost investor capital, but again, you have to speak hypothetically. If we lost it, their life would not be wrecked. Their life would not be ruined, right? They didn't put their whole savings in. It's a percentage of their net worth or liquidity, right? So these investments, passive investments in these alternatives, whether in multifamily or industrial or whatever asset class, it's very uncommon that you see a minimum below 50,000. And I will say, as prices have gone up in the last several years, and as it's gotten much harder to sort of raise and allocate capital because of the market environment we're in, I've seen minimums go up. A lot of guys I know that were at 50 or at 75 or 100, and the math makes sense, right? If I'm raising $20 million, would you rather raise $20 million from $100,000 each or $50,000 each? You literally have double the amount of people, right? Double the amount of investors, which is double the amount of work, double the amount of documents, double the amount of wires, double the amount of K1s at the end of the year. I'd rather work with investors that write me $100,000 to $200,000 check versus an investor that writes me 50, simply because it's easier. It's less people to work with, right? So I've seen sponsors start to increase their minimum. So long story short, not to get too operationally technical, you do have to have money to invest in these types of projects. And, if you're, I would say if you're a employee and you have a great job, the best thing you can do is start to set aside some cash, right? Set aside some cash every month to build up that $50,000 or that $100,000. I would try to get to 100 and then you invest 50, right? That way, again, we're not burning all your liquidity. Or if you have 200, invest 100. Try to invest a percentage of it. You don't want to necessarily invest the whole thing on one deal. That's one thing. The second thing I will highlight, and I would argue probably one of the most common ways that your sort of everyday person gets started passively investing in real estate is they're actually not using cash. They're using their self-directed IRA, or they're using their IRA or their 401k. So the beautiful thing about what we do, and a lot of people don't know this, so if you have a 401k or an IRA and you're listening, take notes on this. You can actually convert your IRA or your 401k into what's called a self-directed or solo 401k. And what that does is it's through a custodian, so there's a third party involved, but it converts it to a position where you can actually invest in alternatives outside of the stock market, outside of the equities market. So residential housing, commercial multifamily, passive investing. There's a long list of alternatives that you can invest in using a self-directed IRA or solo 401k. There's a short list of stuff you can't do as well, which is government regulated. But if you have a 401k or an IRA, if you're approaching retirement and you have, I talked to a guy, I remember this guy because it was more recent. I talked to a guy maybe a month ago. He had $4 million in his self-directed IRA, right? Just like an insane amount of money that he rolled over because his IRA had just grown and grown and grown. And he had a really good job and he always threw a maximum amount in there for the last, 30, 40 years. He was like retired, right? And he had $4 million and he's like, yeah, I want to invest. I'm like, that's cool. That's awesome. Right. So him writing a $50,000 check when he has $4 million, that's nothing, not a big deal. But you can use your IRA to passively invest into these projects through a third party custodian. So there's a lot of big companies out there that do this. You can get on a consultation phone call with them. They won't charge you anything and they'll walk you through, is your IRA or your 401k convertible? And then if so, what it would look like to work with them. And they walk you through the process of converting. And then you can come to guys like me, sponsors, operators, and say, hey, I want to invest. I have a self-directed IRA. You always want to ask, do you work with self-directed IRAs? Because some sponsors might not take IRA capital. Most do, but some might not. And that's a great way to get started. It's not how I got started. I just had cash, to be honest. I was just saving cash and I had some cash savings, and I was also making money in real estate on the single family side, and I was rolling it over into the multifamily. So I had a small portfolio of residential houses, and I would sell them and take my proceeds and invest with it into multifamily, if that makes any sense. So I had some houses where I only held them for a few years, 2-3 years, but the market was booming so fast that even after only holding something for 2 years, I was walking away with $50,000, $60,000 in profit. Right? I'll take that 50, 60,000 and I'll put it passively into one of our deals or into a deal I like, right? So that was sort of my process, but everybody's journey is totally different. Some people have a lot of money and they have cash. Cool. Use that. Some people have a large 401k or IRA. Cool. Use that, right? There's a lot of different ways you can get in.
Yeah, no, definitely. I'm glad you brought up the IRA too, because that's such a powerful tool that, again, a lot of people don't know about. And that's how I invested in my first syndication. Was through a self-directed IRA, right? And I knew that by getting in front of people like you and, just hearing about this process, how that works. And then, I, again, got in touch with a custodian, and it's a pretty simple process. It takes a little work to get it all set up, but once you do, it's pretty streamlined there. And so, so Brian, I want to kind of shift a little bit, and, you're talking with passive investors probably on a daily basis, I would imagine, right? If you could, I want to get your take on this because we're in different times right now, right? I mean, we've seen interest rates climb. I know for me, and I know a lot of others have expected them to actually drop by now, but the Fed's holding strong where they're at, and some have even possibly said they might even raise them again. And so who knows what's going to happen, but I'm curious to see, when you're talking to the investors and they're asking the questions of, well, what do you think the market looks like? Where do you see real estate going? Interest rates? Do you see that rising? I'll point out, I know we're seeing a lot of distress right now in multifamily, which in distress creates opportunity. I'm seeing deals go 20, 25% off asking price, right? So, 20, 25% discounts right now. So, the people that do have capital and the liquidity for that are taking advantage. But what are y'all at Headway doing? What are you telling investors when they're talking about, what you foresee in the current market and in the next year or so?
Yeah, I appreciate you asking. I don't have a crystal ball, but I'll share my opinion of what I'm sort of seeing.
Yeah.
This is my first real estate cycle. And I think every cycle makes you a little bit wiser. So I was in college in 2007 and 2008 where the great financial crisis hit, and I was just kind of watching from afar. I didn't have two nickels to rub together, so it didn't really matter. But I do spend a lot of time looking backwards and looking at previous, what happened in the 70s and the 80s with Paul Volcker, where interest rates shot up into the teens. I obviously looked at the great financial crisis and sort of the subprime mortgage situation, and then looking at some of the current data to try to figure out, again, I'm not an economist, but what could happen here, and where can we, our job as sponsors is to mitigate risk and to make sure that if we're acquiring properties that we're checking as many boxes as we can to mitigate risk so that our investors have upside with not as much downside, right? Of course, there's always risk. We can't go to 0% risk, but we want to mitigate as much as possible. So I think currently, my mindset is just to kind of keep it simple is I like to use quotes from people that we all know, like Warren Buffett, right? Has a great one. He likes to say, he said once before is when people are greedy, you should be fearful. When people are fearful, you should be greedy, right? When there's blood in the streets, you should take advantage of it. Even there's somebody else has another quote. I saw this the other day. I don't remember who says it. He said, when there's blood in the streets, you should take advantage of it, even when it's sometimes your own blood. Right. Which is, I was just like, wow, that's so powerful when you really think about it, because the longer you're in this game, in any game, any investing game, I want you to find me an investor that bats a 100, has never, every time they step up to the plate and they swing, they hit a home run. Nobody does that, right? You're gonna have some base hits, you're gonna have some strikeouts, you're gonna have some bunts. It's gonna kind of be all over the place. But the name of the game is just staying in the game and always being active. So my philosophy right now, or my thesis is right now there's a lot of fear, especially if you're only reading the headline. Then I would highly encourage your listeners to not only stop and read the headlines. I mean, the headlines can be very misleading, right? They're reporting what they want to report to evoke emotion, whether good, bad, ugly, right? You have to actually look past the surface and dig deeper and try to find credible sources where they're I hate to say unbiased because everybody's biased, but there's subjective and objective, and you want to be as objective as possible, right? Use the data, make your own decisions. And the stuff that you're reading in the headlines is very misleading about the strength of the economy and the labor market. For example, we just had a strong jobs report that came out. It said there were $272,000+ in jobs created. But when you go back and look at it, you'll notice that 80+% of those jobs were government created jobs, and the rest of them were all part-time jobs. And we lost 400,000+ full-time jobs. That doesn't sound like a great labor market. Go check the headlines. The headlines last week all reported super strong labor market, strongest labor market ever. Fed is not going to cut interest rates because the labor market's so strong. I'm not buying any of it, right? Because if you look at the data, you can actually see what's going on. So for me right now, I think we are approaching the end of this sort of higher for longer phase. I think we will slowly start to see interest rates cuts. I still think there's going to be anywhere from 1 to 3 rate cuts this year. I think we'll probably see a rate cut before the election season opens up and people start debating, so that the Fed doesn't necessarily look like they're being influenced by the political parties. But if unemployment continues to creep up, which we just hit 4% unemployment based on the data released last week, the Fed goes on to high alert anytime employment crosses 4%. They consider that sort of risky territory, right? And they know, they're smart, way smarter than I. They look at the actual data. They're not, Jerome Powell's not reading CNN and CNBC and the Washington, Post. He has the actual real data. So I think we're closer to a cut than we realize. I don't think they're going to give us a lot of warning signs about the cut, because historically they don't ever wave a flag saying, hey guys, 2 meetings from now, we're going to be cutting. Because what happens when Jerome Powell speaks and they start to signal, it influences the market, right? Anytime they say or do anything, the market gets heavily influenced, and you see the treasuries go crazy, and the SOFR rates change like minutes after Jerome starts speaking. So they're not gonna hint like, hey guys, we think a rate cut's coming, because what happens, they're going to influence the market. It's going to pick up demand, and that can cause an uptick in inflation. They're going to randomly cut when you least expect it, right? Yeah. So I personally think we'll see a cut, sometime this summer. I think it's going to be small, 20, 25 basis points. I think they'll do 20, 25 basis points every time, 1 to 3 times this year. And then they'll wait till the election season's over and we'll start to see some more rate cuts next year. And with that being said, you're right. Prices are down in the multifamily space 20 to 40%, depending on which market you're at, what asset class you're looking at, how big the asset is, how much distress it's seeing. So if things are on sale, I like to buy things when they're on sale. I don't know about you. My wife loves to shop when things are on sale, right? So I want to buy real estate when everybody's scared of it and it's on sale because there's less competition. You're buying it at a better price. You just have to understand all the inputs that go into it and make sure you have a solid business plan going in. You have to be well capitalized. You got to make sure you have the right debt on the property, whether it's fixed or floating. There's a situation for both. It's not one's better or the other. You got to have the right business plan, and you got to make sure you're buying it at a basis that makes great sense so that when you sell it in 3 to 5 years, because that's how long we hold these properties, you're going to be really, really, really happy. And that's sort of my thesis right now is look at all the deals, try to find something on sale or at a discount, put the right debt on it, get it at a good price, hold it for 3 to 5 years, and then we're going to sell it and I'll be super happy because in 5 years, we're not going to be having this conversation about high interest rates and inflation. The market's going to be back up and running, so to speak. I don't think rates are going to 2% ever again. I think they will stabilize in the mid-high 4s, low 5s. I think that's where we'll end up sitting versus the 7 and 8% interest rates that we're kind of seeing now. But yeah, so my encouragement to all your investors, especially if they're passive, is to be looking at deals because you're going to see some very unique opportunities that you'll probably not see again for a long time, right? How often can you invest in properties that are 30% off, pre-foreclosures, special debt notes? I mean, there's all kinds of stuff out there that really gives you a lot of upside, and there's still risk, right? Investing during choppy waters, of course, is risky, but no risk, no reward.
Yeah. No, very, very well said. And, I think what sums that up there is, if you go to the store and something's 20 or 30% off, why would you not buy it? Right? Like it's a no-brainer. But, when it comes to real estate and these asset classes, it's scary, right? Everybody's scared. You're reading the headlines like you were talking about, and it's emotion, right? It's emotion. But how many times, Brian, would you wish to go back? I mean, even just to 2018, 2017, sure. 2018, and scoop up all these houses or these commercial assets, right? And be able to sell them in 21, 22, right before Absolutely. That rate hike.
Like, I ask people that all the time, right?
Yeah.
Hindsight's 2020. If you were to go and poll all your audience and ask if they could have bought real estate coming out of the great financial crisis in 2011, 2012, 2013, would they have? I bet you 10 out of 10 would say yes, or 9 out of 10, a very high number, right?
Yeah.
But if you were to ask them actually in 2010, 11, and 12, go back and look at the headlines. Right. They would have all told you were absolutely out of your mind and I'm never giving you a penny for bringing up real estate, right? The similar situation is happening right now, right? Everything's on sale. People are scared of real estate. The headlines are printing stuff up that mostly has to do with office. Also, office is the thing getting most decimated right now, but the headlines just say commercial real estate or real estate in general, right?
Right. And so focus on the asset class, right?
Right. And then in 5 or 10 years, we're going to be having the same conversation again about, man, 2024, 2025, man, all that stuff was on sale and I should have invested. I should have bought something.
Yep.
And it's always, I should have, because I always say, if you're not active, the good deals, they're in your rear view mirror. You missed them.
Yep, absolutely. So hopefully the audience can take something from that is pay attention to what's going on right now and do your due diligence. Once you find something that looks good is really, really, again, dive deep into the deal or go beyond the headline, so to speak, right? Is really, because I'm glad you brought that up, Brian, because that kind of came to mind whenever, the journalists, they just talk about commercial real estate as a whole. But office, got, decimated, right, during COVID, but it's honestly, that's making even a comeback now, right? So you're starting to see things increase a little bit. But again, all these numbers are factored into all the commercial space. So just definitely do your due diligence. Again, find the right operator. We always talk about the know, like, and trust, factor. So, definitely just keep your eyes open, right? I think is the moral of what we just went over is pay attention right now. Because I know for me, I got my capital that I'm ready to invest in some opportunities that, you got to look at this real estate as long term too. It's not to get rich, in 3 to 5 years or even 7 to 10 years, right? Just what do they say? I like that. Start with the end in mind. Where are you going, and just create a pathway to get there. So, well, Brian, I want to transition for into our what I like to call the fire round. And what we're going to do is I'm going to ask you a set of 4 questions. And first one being, if you could recommend a book on real estate that you think would be beneficial to someone just starting out or just new to this space, and then another book on cultivating a positive mindset.
Oh, that's a good question. I think if you're looking to be active or passive, my answer definitely changes. You've probably had somebody say this, but just sort of a mindset thing. It kind of goes real estate, kind of doesn't. It's definitely your rich dad, poor dads, right? That's just everybody. You've probably gotten an answer 100 times, but it's so true as far as framing your mindset around just this how to be an entrepreneur, how to be an investor, and not making all your money in one place, building a second stream of income. The ABCs of Real Estate Investing by Ken McElroy is one of the books in that same Kiyosaki sort of library. And Ken McElroy does a phenomenal job, I think, of breaking things down. He's got the advanced ABCs of real estate. That was one of my first books I read as well, trying to be an active investor. I think those are great places to get started. And as far as mindset, that's a great question. I have a lot of books on mindset. I think anytime you're investing in anything, you're going to experience ups and downs. That's so important to understand before you get in, because you're going to have days, especially if you're a hungry, motivated, I don't want to use the word instant gratification, but you want it and you want it quick. You want to get there. You want the results. You want the inputs, right? It's going to be challenging because it could take you 3, 6, 9 months, a year more to find that first opportunity, whether it's passive or active, that really aligns with your personal goals, your financial goals, and your investing thesis and your risk tolerance. So you got to be really patient. And, as far as books go with mindset, I really like one I read when I was really young that I try to read once a year. I like the 7 Habits of Highly Effective People by Stephen Covey. He's got a whole library of books. I think that's one of the best books as far as like just having a really good mindset on how to be an effective person. It's not necessarily for business. It can be used for business, but it's for being a dad. It's for being a mom. It's for being a great employee. It's for being an investor. It's for being an entrepreneur. It's just how to be effective in life. And it's a timeless book. Anytime you see a book that is still in the top list of books today, and it was written, 40 plus years ago, the principles in it are tried and true. So that's definitely one of my top books.
Yeah, no, great suggestion. Yeah, definitely. I've read both of those books, and Rich Dad. I mean, yeah, it has been mentioned here, and it's almost mentioned, probably 50%, 60% of the time I ask this question, but it was life-changing for me as well. Like, it just totally shifted my whole mindset. So I definitely encourage anyone, if they have not, check that book out or read that book, please go grab it like now, like just end the call and go grab it, but I want to just throw one more in there or ask you, Brian, have you read the book Go Giver?
I think I have it on my shelf. I don't know if I've read it. I have 200 plus books in my library, and there's so many that I haven't read.
Gotcha. I'd recommend. It's a short read, but okay. Just finished that book. It's a parable, which I love those. But yeah, just a great book, and it really just piggybacks off that 7 Habits of Highly Effective People, and what he talks about in that book is, just go into it with the heart of service, right? And just give back what you can, and in all areas of your life, personal, financial, right, family, and you will be successful. You'll be well taken care of, and that definitely plays into the mindset part as well. So, yeah, you read a few of these books, and you just kind of like, you got to read this book, right? It's one of those there. And if you have Audible, it's free on Audible too, by the way. Yeah. So All right, next question, Brian. Can you share a specific goal or dream that holds significant or special significance to you?
A goal or dream that holds special significance to me. I would say a big goal or dream that's is really close to me is, I mean, for a long time it was starting a family, and my wife and I are very blessed. We have our first one on the way. So about three and a half, 4 months. We'll have a little me running around, a little girl. So it'll be really fun. So that was a big goal for me. And as far as changing the family tree, trying to instill upon her the things that I've learned. I mean, I'm not perfect. I'm sure I won't be perfect. My parents weren't perfect. Nobody's perfect, but trying to instill those things I think are really important. And then sort of, I would say another goal would be, I would love to, just kind of personally, I would say I would love to pay off my current house. That's just like a thing that I'm trying to do sooner rather than later, just to free up some cash flow, go and invest in more stuff. Yep. So I would say that's definitely on my list of stuff. Hopefully in the next few years, I can get that taken care of.
That's awesome. Well, congratulations on your little girl, man.
Thank you.
Yeah. I'm excited for you. And that's a big one there. That's a big goal. How do you structure your day to maintain a healthy work-life balance? So do you have like a morning routine you can share, or anything you do there?
Yeah. I'm a big Miracle Morning guy. Now, I will say I've created my own version of it. I think when I first read it, at least 6 or 7 years ago, I was trying to be really strict to it. And I found that trying to force myself to do the exact Miracle Morning actually left more like a bad taste in my mouth, where I didn't want to do it. So I kind of created my own version of it. But I definitely try to wake up within the same like 30-minute window every day, which is usually between like 5 and 5:30, even on the weekends. And I go and work out usually 4 minimum, but more than likely 5 times a week. And that doesn't mean I'm like going to the gym for 3 hours, and like, sometimes it just means going for a light jog or a 30-minute walk in the morning, right? Something to keep the body moving, I think is really, really, really important. And then kind of after my workout in the morning or my walk or whatever I end up doing to kind of keep the body moving is I'm really big into time blocking, because we have so much stuff going on here at Headway. We're growing. We have investors that have needs. We have properties we're working on. We got stuff in the pipeline. We're hopefully looking to work on here in the future. So if I don't time block my schedule, nothing gets done. So time blocking is really important to me. So before I go into a week, usually on Sunday night, if not first thing Monday morning, but usually Sunday afternoon, I will build out my schedule for the week and say, okay, what is important this week for work? And I'm highlighting that because that's also how I carve out time for non-work things, right? So I have my gym workouts in the morning on my schedule, and then I have my afternoon stuff. If I'm taking my wife out for a date night, or if we're hanging out with friends and family, or if we're going to the movies, if we're doing anything, I try to live on my schedule. I like to joke with my wife that if it's not on the schedule, it doesn't happen. So time blocking is really important for both personal and professional. Yeah,
no, I love that. I do that on Sundays as well. I have like a planning session of what I call it. Yep. Spend an hour and a half, 2 hours, just kind of planning out the week. And I'm curious on your time blocking. Do you niche down? Because I've heard different things. Some people just block the time and then get what they need to done in that time. Or are you like scheduling every call? Everything.
Yes, I'm granular.
You're granular. Okay. Yeah. Which I think I'm working on niching down a little bit more, because I find even when I do block that time, I got to be really intentional on what I want to do, or else I just I'm figuring 30 minutes, half of that time figuring out what I need to do. Right.
Sure.
So it's definitely learning as you go there. And I will share, that time block is good, especially when you have the kiddo around.
Oh yeah.
Things will change for sure. Get those workouts when you can. All right. So if you could be remembered for one thing, what would that be?
Remembered for one thing. Mm-hmm. Wow. I don't think I've ever been
deep here, Brian. We're getting deep.
Yeah. I don't think I've been asked that one on a podcast. I would say I would like to be remembered as somebody who always served others. Yeah. I believe personally that that's what I was put on this earth for. Selfishly, do I want to succeed and sort of get all the, the things that come with success? Sure. But I think really where that's going to come from is just being really good at serving others. So when there's an exercise that says think about your eulogy and you've passed, and your kids and your family and your past coworkers and all the people that come to your funeral are there. What do they say about you? And it's a really powerful exercise. And I don't do it as often as I probably should, but I have done it, and I do think about that. And it's just trying to be remembered for good things, because none of us are perfect human beings. And I would say for me, it's just like I want people to stand up and be like, man, Brian was always there for me. He always served me, and he always found a way to give back and to help when he possibly could. So I'd say that's what I'd like to be known for.
No, that's awesome, man. Great answer. And, that's actually where that question stemmed from, is kind of looking at the eulogy, that dash in between those years of, how did we show up? What are we going to be remembered for?
Right.
And, another thing to add on to that is, you sit down and you talk to the people that have, that are a little bit ahead of us, and, the regrets and things, they wish they would have spent more time with their family. They wish they would have showed up more in these different, areas of their life. And for me, I try to learn as much as I can from that. Like, growing up, I grew up without my father in my life. And so it's just so important to me to be the father I never had to my kids. Sure. And be present and really just, helps me develop my why and the reason I am doing all this. Right. And I love the answer of just being of service, because that's what I want to be. I want to be of service to my family, my kids. Right. I want to show up, do the right thing, and show them how to live too. Show them how to be respectful, kind, men and women have integrity, and that's the goal here. Right.
Yep.
Well, awesome, Brian. Well, I really enjoyed having you today. And if you could just tell listeners, if they want to connect, where they can go to learn more and then, have more conversations with you.
Yeah, I would love to connect with anybody in your audience that's interested in either being an active investor and kind of learning about how to do what I do, or if you want to passively invest with us and partner with us and have that conversation, you can go to our website, Headway Investment with no S, so headwayinvestment.com. You can also reach out to me directly at brian@headwaycapital.us. You can also look me up on LinkedIn. Just type in first name Brian with an I. Last name Alfaro, ALF, as in Frank, ARO, and I should pop right up as well. I would love to connect with anybody who's interested in chatting.
Awesome. Well, thank you, Brian. Enjoyed it.
Awesome. Thank you.
Thank you for listening to the Optimal Wealth Podcast. If you enjoyed this episode, please be sure to rate, review, subscribe, and pay it forward by sharing with a friend. Most importantly, be sure to optimize your results and take massive action on what you have learned here today. For more, visit optimalequitygroup.com.